What do I need to understand when I look at my audited financial statements? We're a nonprofit. I love that question. Of course, how could I not love that question? Of this, the things like marketing materials of CFO firms are made. But I promise you, this was asked to me this week, and I delivered the goods on Monday morning. The most important thing I would say to look at is not a single number. The most important thing to consider is having more than one number to look at so you can see a number in context. A number by itself doesn't mean a whole lot. Hey Kim, welcome. Kim is a fellow accounting professional. Welcome to the show. So glad you're here. Looking forward to your questions and your answers, if you have any answers to questions that have been posed to me during the course of the week. All right. So we have two intrepid entrepreneurs right now on the live show with me. Awesome stuff. So what do I need to understand when I look at my audited financial statements? Hopefully those financial statements are comparative financial statements, which means it shows the year that was just completed and the year before it. So it's the coolest thing to not just get one number, but to get multiple numbers in relation to each other. So you might look at the obvious, like gross revenue. How have gross revenues changed over time? Then you might dig a little deeper and say, well, how have gross revenues changed over time in relationship to the cash in the bank? Well, because if gross revenues are climbing, hey Samantha, if gross revenues are climbing and cash is staying the same or falling, right? That could be problematic. I'm showing gross revenues climbing, but what's happening to all that money? Is it not coming in the door in the first place? You can compare, and I mean it's even in the context of a nonprofit. Are pledges not materializing? Are people making pledges? So on your audited financial statements, you're showing that pledge income, but what if people aren't paying? Why is that? It's important to get to the bottom of that. Is it because no one is reaching out for follow-up? Is it because they're not on automatic credit card pulls? Is it because something broke with the technology and it's not coming in the door? Have a look. And by the way, these types of comparisons are not limited to the audited financials. You can do this anytime if you have a clear set of books with these kinds of arrows in your mind going, look here, it matters. Look there, it matters. So you can look at income trends. You can look at the relationship of changes in income to the relationship of changes in cash. And when I say cash, I mean what's in your organization's bank account. You can look at other relationships, like let's say the change of payables over time and the change of receivables over time. Remember, receivables is what's been promised to you by your donors or your customers or your clients. Payables are what your organization has promised to other companies who are providing you goods or services. So in general, with a company that's growing, you would see some climbing in both payables and receivables. Well, what do those trends look like? Are they climbing at more or less the same rate? Is one taking off at a faster rate than another? And is that working? So those are some things to look at. And of course, you also have the big P, profitability. So income can do whatever it wants, but if expenses are skyrocketing, you're still going to have a huge loss. So, until it's tax time, everybody doesn't want losses. Everybody wants huge net income. And then all of a sudden to magically turn that into a loss come tax time. But that's another conversation. So look at the relationship between income and expenses. There are two types of expenses in this context: variable and fixed. Jargon alert. Boop, boop, boop. I swear we need a soundtrack. Like every time Jamie says jargon, I need to have a klaxon in my ear, like ah. So if variable expenses means the more income you get, the more variable expenses you have. The less income you have, the lower level of variable expenses you have. A good example of that would be if you pay workers by the hour and charge clients for some multiple of that, which is very common in professional services. An example of a fixed expense is, let's say, rent. Let's say you have rent of $2,000 a month for your various office spaces, And if income fluctuates by plus or minus 25% in a given month or in a given year, your rent is still your rent, right? I mean, you're still paying $2,000 a month for rent, even if there's a huge windfall. It takes a huge change in income to require a change in rent, because now you need a third warehouse or a bigger office space or whatever it is. So it really takes a whole lot to change a fixed expense. So take a look at that. How much of your income is variable, is produced by using variable costs, and how much of your income is produced by using fixed costs? When you look at the audited financial statements, this can make a huge impact in your strategic decisions. The more you have in fixed costs, the less expensive it will be for you to grow rapidly. On the other hand, the more you have in variable costs, the lower risk you have. So that's something to consider when you look at your audited financials. And if you're a non-for-profit, also you'll want to look at program fees, administrative fees, and fundraising fees. And as much as I don't like it that a lot of donors make decisions based on that information, it's still something to keep track of. It's part of, unfortunately, a donor decision-making process, but it will also inform how you share the organizational results. If quote-unquote overhead is higher than maybe standard averages, maybe there's a really compelling case for that when you present that information to your donor base, because they can find it anyway. It's going to be in your 990, it's going to be in your nonprofit tax return. They can find that information. Plenty of people look for it. If you can present a compelling case of outcomes that would not have been possible but for the investments in overhead, like we bought a building, we brought in a high-powered business development director, we brought in a high-powered executive director, and as a result, 500 more people have a safe place to go every day. As a result, 20,000 more people are fed every day. As a result, XYZ. You can really emphasize those outcomes, because it's a huge thing, as you know, in the nonprofit world, where it seems that the impact is pushed down because of an expectation. I don't even want to start the soapbox right now, but because of an expectation, like every dollar should go directly to services. You know what? Overhead and fundraising are an essential part of those services, making them happen. There would be no service happening if it weren't for a program director, an executive director, and a development director, for example, out there creating this organization as a container for these amazing outcomes to show up. So yes, there's more than that you can get from your audited financials, but I think that'll be enough for today.